Welcome to this budgeting masterclass. We'll explore what budgeting is, why every business depends on it, and how you can prepare budgets with confidence. Imagine tomorrow morning you become the CEO of your own business. Before you even open the doors, you'll need to make hundreds of decisions. How many employees should you hire? How much stock should you buy? Can you afford better equipment? What should you charge customers? Do you need a bank loan? Will you have enough money to pay bills? How can you answer any of those questions if you don't have a financial plan? Without a budget, we have a danger to hire too many staff. Our payroll can become unaffordable, cash gets trapped in inventory, interest costs explode, business runs out of cash, sales increase, but profits disappear, and bills can't be paid. That's why every successful business, from a local cafe to multinational companies, prepares a budget. So budgeting exists because businesses cannot afford to make important decisions by guesswork. Companies don't start by preparing a budget, they start much earlier. Let me show you how a professional company actually works. This is the complete planning process. The budget is only one step. Everything starts with a vision. The vision simply answers one question. Where do we want the business to be in the future? It's the long-term dream. For example, become the largest coffee chain or become the world's leading electric vehicle manufacturer. At this stage, there are no numbers, no revenue, no profit, just direction. Next comes the mission. The mission explains why the business exists. In other words, what value are we creating for customers? Finance still isn't preparing budgets. Strategy. Now management starts making decisions. How are we actually going to achieve that vision? Will we expand and open more stores, launch new products, or invest in technology? Objectives. Strategy is still quite broad, so management converts strategy into measurable objectives. Increase sales by 20%, reduce costs by 5%, open 3 new branches, improve customer satisfaction. Now we're becoming more specific. Management writes the business plan. The business plan explains exactly what the company intends to do during the next year. Which projects, departments, activities, who is responsible, what resources are required. Think of it as the company's roadmap. The finance department now asks a completely different question. How much will all of this cost? If we're opening 3 stores, how much rent, equipment, inventory, cash are required? Can we actually afford this? The answers to those questions become the budget. But business never goes exactly according to plan. Sales change, costs, inflation, interest rates change, and customers. So companies regularly update their expectations. That's called forecasting. Once the year starts, we compare what we planned against what actually happened. That's reporting. Finally, management uses that information to make better decisions. Should we hire more staff, increase prices, reduce costs, and delay investment? Then the whole cycle starts again. Now that we understand where a budget fits within the business planning process, let's answer the next question. What exactly is a budget? And how do professional companies actually build one? A budget is a detailed financial plan prepared before the beginning of a future period, usually 1 year, that translates business objectives into expected revenues, costs, cash flows, and financial performance. Budgets follow a logical sequence. Professional companies almost always start with sales, because sales drive almost everything else. Everything starts with revenue. Without knowing expected sales, we can't calculate production, we can't calculate purchases, labor, and we can't estimate profit. Sales are the engine of the entire budget. For an example, our expected sales is 10,000 units, selling price $50, revenue $500,000. Now we have our starting point. Next is production budget. If we expect to sell 10,000 units, how many do we actually need to produce? Maybe exactly 10,000, or maybe 11,000, because we want inventory, or maybe only 9,500 because we already have inventory. That becomes the production budget. Next is materials budget. If we're producing 11,000 units, how much raw material do we need? Steel, wood, plastic, packaging. Everything must now be calculated. Now we know production, so we ask another question. How many employees do we need? Can existing staff produce everything? Or must we recruit more employees? The answers become the labour budget. Next is overhead budget. Now we estimate everything else: rent, insurance, electricity, marketing, office costs, software, telephone and professional fees. These become overhead budgets. Next is capital expenditure budget. Do we need new machines, new vehicles, computers and buildings? These are long-term investments. They don't appear immediately as expenses. Instead, they become assets on the statement of financial position. Next is cash budget. This is one of the most important budgets. Remember, making a profit doesn't mean having cash. Customers may pay in 60 days, but suppliers may need paying today. The cash budget tells management whether the business will actually have enough money to survive. Once all revenues and expenses have been estimated, we can prepare the budgeted income statement. Now management can finally answer, will the business make a profit? Final step is budgeted statement of financial position. We estimate what the business will own and what it will owe, and how much equity the owners will have at the end of the year. Every budget we create depends on the one before it. If the sales forecast changes, production changes. If production changes, materials change, labour, overheads, cash and profit changes. That's why the sales budget is often called the driver budget or the starting point of the budgeting process. Let's start with the most common budgeting method used by businesses around the world. The traditional budget, also known as incremental budgeting. The word incremental simply means making small changes. Instead of starting from scratch every year, management begins with last year's budget and asks a simple question. What has changed since last year? We adjust the existing budget to reflect the expected changes for the coming year. The last year's budget has already contains all the major costs of running the business: staff salaries, rent, utilities, insurance, marketing, travel expenses, and many other operating costs. Management assumes that most of these activities will continue into the next year, so rather than creating a completely new budget, they simply update the existing one. The first adjustment is often inflation. Prices rarely stay the same. Suppliers may increase their prices. Utility bills become more expensive. Insurance premiums may rise. Rent may increase under the lease agreement. Next comes business growth. Suppose management expects sales to increase by 15%. Higher sales usually mean producing more products or delivering more services. As production increases, the company may need more raw materials, more packaging, more deliveries, and possibly more customer support staff. The budget therefore grows alongside the business. Another common adjustment is employee salaries. Employees may receive annual pay rises because of inflation, promotions, or market conditions. Finally, management considers any new projects planned for the coming year. Perhaps the company wants to launch a new product, open another branch, purchase new machinery, or invest in additional marketing. These activities didn't exist last year, so new costs are added to the budget. So the traditional budget follows a very logical process. We don't throw away last year's work. We use it as a foundation. Then we adjust it to reflect the expected changes in the business environment. That's why this method is often called incremental budgeting, because the budget changes incrementally or step by step, rather than being completely rebuilt. Next type of budget is zero-based budgeting. Zero-based budgeting works very differently. Instead of asking, what should we change, management asks, if we were starting this business today, would we still spend this money? Every single expense must be justified. Nothing is automatically carried forward. The budget starts at zero, not because the business has no money, but because no expense is automatically approved. Every department manager must justify every dollar they want to spend. Next type is a rolling budget. A rolling budget is never finished. Every month or every quarter, management updates the budget by adding another future period. Imagine today is the end of March. Instead of keeping a budget that ends in December, we update it to include next January. The company always has a full 12-month plan. Next type is flexible budget. Flexible budget is not a new budget. It is the original budget recalculated for the actual level of activity. Imagine we budgeted to produce 10,000 units, but demand was stronger than expected and we actually produced 12,000. Naturally, our material costs will increase. It would be unfair to compare the actual cost of producing 12,000 units with the original budget for only 10,000 units. Instead, we prepare a flexible budget. We recalculate what the costs should have been for 12,000 units. Then we compare that revised benchmark with the actual costs. This gives management a much fairer measure of performance. In other words, a flexible budget separates the effect of higher activity from the efficiency of managing costs. Let's build the budget. Every budget starts with sales. If we expect to sell 10,000 units at $20 each, our budgeted revenue is $200,000. This is the most important budget because almost every other budget depends on it. Next is production budget. We expect to sell 10,000 units, but we also want to finish the year with 500 units in stock. Since we already have 300 units in inventory, we only need to produce 10,200 units. Once production is known, purchasing can calculate how much raw material is required. Next, we estimate the labor needed to manufacture the products. These are the operating costs needed to run the business, regardless of production. Profit is important, but businesses survive on cash. The cash budget tells management whether the business has enough money to pay its bills. Finally, management estimates profit, what the business will own and owe at the end of the budget period. Notice how every budget depends on the one before it. If expected sales change, production changes. If production changes, materials and labor change. If those change, cash flow changes. And ultimately, profit and the financial position change. This is why budgeting is about understanding how one business decision affects every part of the organization.